Hi guys, welcome back to the Joyful Investors channel. Recently, I did a very brief and short survey among 5 of my friends to obtain an understanding of what they think about investing and how they go about doing their investing. So guess what the results were? Out of these 5 friends, only one of them knew what a moving average is and naturally uses a moving average to determine the price to buy a particular stock. So for the remaining 4 friends, they buy stocks at a price that they think is a good price without performing any technical analysis or even fundamental analysis. Not having any financial knowledge is also not an excuse because all 5 of them have a finance related degree. So is investing really just a game of luck? The answer lies within your mindset. Investing can be a game of luck for some, but not for all. If you treat investing like placing a bet in the casino or buying a lottery, then chances are that your returns will also be as uncertain as the win rates in the casino or for a lottery. You simply jump into the market without knowing what you're getting yourself into. But there's so much more to investing. Learning to invest is definitely not easy. There are so many investing jargons and strategies that you need to know about. Knowing when to enter the market or exit the market also involves skills and strategies. Often, people who do not know about such skills and strategies will think that investing is just all about luck. In investing in stocks, the first step I take is to first identify the fundamentally strong companies to buy. So usually I'll apply a set of criteria to screen for the good companies before deciding whether or not to add these stocks into my watch list. So some of these criteria including examining the revenue, the earnings, or whether they have a healthy cash flow. If you want to know more about this, do subscribe and stay tuned to our channel as we'll be uploading more of such contents later on. But this step alone is definitely not sufficient. And that's because for good stocks, it could be overvalued because of the hype. Because remember, in the short term, stock market prices are driven by emotions and sentiments or manipulated by the market makers. What we do not want to see is the situation whereby we enter a long position for the stock right before the prices drop or retrace to a previous support level. This is why we have to perform technical analysis by analyzing the charts and indicators to find an appropriate entry point, which is usually during a price correction or when the price retraces to a certain level. We definitely do not want to buy a stock when it is at an all-time high. The concept of valuation is also crucial as ideally we want to buy stocks at a discount when the stock is undervalued. And therefore, we'll usually compute the intrinsic value of the stock and we'll use this piece of information together with the indicators that we get from the technical analysis to determine the entry point. If you want to know more about valuation, do watch our video Misconception of Cheap and Expensive Stock Prices to know more about it. In actual fact, if you invest in good stocks and let them work for you, you should generally see good returns over the long run. Because we always say that in the short term, the stock market is a voting machine and in the long term, a weighing machine. But this is not how it works for betting or gambling. Risk management is essential. Another reason why people often associate investing with luck is because they do not understand the importance of risk management of their investment portfolio. Diversification is one such strategy in which you can manage the risk of your portfolio. So for example, you can actually diversify by the asset type, say investing in stocks, bonds, or other instruments. You can also possibly diversify by geographical location by buying stocks of various countries. You can also diversify by industry by buying stocks from different industry, say the healthcare sector or the technology sector. Dollar value averaging is another strategy that you can use to manage the risk of your portfolio. It is a strategy in which you buy more positions when the stock prices are decreasing and you buy fewer positions when the stock prices are increasing. If you have not watched our video, it is dollar cost averaging always good, do check it out as we will explain about the two strategies, the dollar cost averaging and the dollar value averaging, and which is the method that we more commonly use. Understanding the risk to reward trade off and whether it matches with your risk appetite is also critical. It helps you to invest only in securities that are within your risk expectation level so that you're aligned to your own set of investment goals. I'm a true believer that investing is not just about luck. If it is anything close to a game, it will be a game of risk management. Because investing involves acquiring the relevant knowledge and skill sets in order to see meaningful gains in your portfolio given a reasonable amount of risk. Many times, it also involves having a disciplined mindset and a strong mental state to prevent your irrational emotions from overriding the logical thinking. It is only those who do not have a game plan will think that investing is just all about luck. Thank you for watching this video. Remember to hit the like and subscribe button. I'll see you in my next video.